Hey, it's Tuesday, August 6th. Welcome back. Subscribe to the channel, like the video, click the bell, tell your friends and family. It's remarkable how many more friends I have on days when stock prices fall sharply and unexpectedly. Yesterday was one of those days. What's happening? What's the cause? What should I do? When will it stop? When stock prices fall too fast, too far, there's immediate calls for the Fed's plunge protection team to take action. Enough already. My message to the Fed is stay out of this. Let markets correct. Good Lord, we used to let that happen. Watch the banks and assist banks when the Fed can, of course, as is their obligation. We cannot eliminate downside risk. Markets must be allowed to clear. Those who manage risk must take the losses, not U.S. taxpayers. Japan started a global wave of selling of stocks on Sunday, and the U.S. markets followed, as did the rest of the world yesterday. By mid-morning yesterday, the sophisticated players were calling for the Fed to intervene, to signal an immediate interest rate cut, or to actually immediately cut rates. Stop it. Fed policy since the Bernanke Fed 2008-2009 has only engendered massive moral hazard in the financial markets. Central bank's job is not stock market protection or plunge protection. Obviously, there can be spillover into the financial sector that can cause harm, and they're responsible to manage that. But that harm has to sometimes be allowed. In the face of the highest rates of inflation for the U.S. economy since the 1970s, in large part driven by Democrat massive deficit spending, the Fed began an interest rate tightening cycle. At that time, when they started their interest rate tightening cycle, the federal funds rate, the overnight interest rate the Fed sets at their Federal Open Market Committee meetings, was at 0.08%, so basically zero interest rates. At that time, the S&P 500 was trading just off the then all-time highs at 4,192 after a 2-year uninterrupted rally. In the face of 5 straight interest rate hikes, taking the federal funds rate to 3.08%, the S&P fell to a low of 3,598 in September of 2022. Since that time, the Fed has raised interest rates another 6 times to bring the federal funds rate to 5.33%. The S&P 500 rallied to an all-time high in the face of those interest rate hikes to 5,665 by July of 2024. The Fed had held rates steady since July of 2023 and coaxed higher stock prices by repeatedly talking about how they are done hiking and a cut is coming, ensuring that wealth effect, protecting pension plans and 401k funds. Meanwhile, inflation remained and remains a problem with yearly rates of inflation well above the Fed's 2% target. The balls on stock market players and some of our most prominent economists, money managers, and hedge fund operators to call for an immediate rate hike in the face of a one-day sell-off is hard to overstate. The moral hazard engendered in markets by horrible Fed policy is hard to overstate and would be greater if the Fed listened to that advice. The Federal Reserve's reputation since 2008 has already been sullied. To cave to markets calling for rate cuts because stock market prices fall risks more reputational damage. The unfairness of it, sacrifice inflation, a tax on all consumers and businesses to save the returns on equity is a bad deal. If you own stocks, if a bank owns stocks, if a company owns stocks, if a hedge fund owns stocks, they have financial risks that they must manage on your own. If you're wrong, you lose money. That's how it works. There are lots of moving parts to consider. And one is what started us off on Sunday in Japan, the yen carry trade. Borrowing in Japan very cheaply, their interest rates have been below the global average for years. Owning yen and using that money to invest in other countries that have higher interest rates. As interest rates globally converge, that is to say, the Bank of Japan hiking interest rates finally has narrowed the spread. And so the payoff of the carry trade has fallen. If the Fed and other central banks lower rates, it will narrow that spread further and again reduce the gains from the carry trade. Everyone's in on this carry trade. So that's impactful for lots of banks, hedge funds, financial market players. In any event, there is no fundamental basis for the Fed or any other central bank to cut interest rates solely because stock prices are falling. I want to remind you or inform you that humans don't directly control the stock market, or for that matter, any other financial market. Algorithms, black boxes drive trading, and they are the source of the unprecedented swings we saw yesterday. They are also the reason why we have rebounds around the world today. It's been this way for decades. It was bad at the start and it's bad now. Put humans back in control. Jerome, buddy, pal, don't do it. Don't cave to Goldman and JP Morgan again. The Dow and the S&P 500 bounced off the lows yesterday, having the losses by the end of the day. And as led by the Nikkei, are rebounding again today. Everybody settle down. The stock market is overpriced. It has been overpriced. It's been in a bubble for years. Some of the gains you've enjoyed over the past 10 years will be lost. That is how it works. Well, prior to 2009 anyway. There's a good strategy for managing falling stock prices or any falling asset that you can have liquidity in. There's something called the trailing stop, an effort to preserve some of your gains, but not all. Pick a stock. NVIDIA. NVIDIA has gone from 1,000 to 2,000. That's a big gain, $1,000 per share. Now NVIDIA starts to sell off again. Now, no one's really smart enough to pick the exact high, so you didn't sell at 2,000. You wanted to let your trade keep running. But now prices are coming back down. You're in at 1,000, so you're going to give back some money as it comes off 2,000. The question is, do you want to give back all that money and let NVIDIA come all the way down to 1,000 or lower before you get out? No, you want to use a trailing stop. So I'm going to tell my broker, sell my position in NVIDIA if NVIDIA drops below 725 or anything lower, anything above 1,000, right? You're going to keep some of your gains instead of all of your gains. A trailing stop, an easy method. At 8:45 a.m. on Tuesday, August 6th, the Nikkei finished their day up 3,217 points. One of the biggest rallies in the Nikkei since 2008. The EU markets finished down small, inconsequential, and the Dow and S&P 500 pre-markets are up, with the Dow trading up 194 points to 39,041, and the S&P up 32 points at 5,249. So the panic is over. The U.S. 10-year has rallied back to 3.8% off the lows yesterday in terms of yield. Remember, bond prices and interest rates are inversely related, though the 10-year is still below 4%, which is bad news. Oil is near recent lows of 72.56. Not surprised that correlation between commodities and stock prices. Metals are offered a bit. The U.S. dollar index fell below 104, though against the euro, it's back below 110 to 109.10. And against the yen, it's off the lowest trade at 144.72, well off 157 just a few weeks ago. All right, so little rundown there. We don't need the Fed. Stop this panic. Let markets work. Markets have to be allowed to clear. Risk has to be applied. All right, let's check on what's coming in the week for the U.S. economy. Again, it's Tuesday. The week after the employment situation report, which is out last Friday, is always a quiet one on the data front. Market participants are left to technical analysis to make the decisions. And of course, headlines, which we'll see a lot of this week. There was no market moving data yesterday, Monday. Today, we got the June goods and services trade balance. Came out showing a trade deficit of 73.1 billion, big surprise. Worse than expected, a little better than the 75 billion in May. Still on pace for another $1 trillion goods and services trade deficit, not good. Wednesday, as always, we get the MBA mortgage applications for the week ending August 3rd. A little check on housing. Comes out at 7 a.m. That's all there is for tomorrow. Thursday, quiet as well. We get the normal data. Initial unemployment claims comes out 8:30 every Thursday. How many Americans lost their jobs last week and had to file for unemployment insurance? And there's nothing out on Friday. So watch your Fed headlines. Watch the Middle East. Watch China. Their economy is crumbling. Watch Biden, Harris, Trump. Watch Bangladesh, the UK, Germany. Pay attention. There's lots of stress and uncertainty out there. All right, that's all I have for you right now. Always try to buy American.